I won't. But no, the idea here, please ask questions on this. Is pretty general on that.
Where did we start?
Beginning.
Okay. There, I'm very confused with
I
what.
don't either. That's fun.
Go back to the top.
Yeah, let's just go there. Or the next one is fine too. Yeah, the next one is good. There we go. So I thought I'd just kind of go over some of the basics of lending 101, kind of that thing, why it's important, I think, to have a decent understanding from your perspective. Do you need to know everything? No, you don't need to at all on that, but go over that, go over some general things like that. One thing I wanted to talk about is FHA versus VA, that type of thing. When you're making that offer, how do you make a strong offer using those or anything else, right? So talk to some various listing agents to see what they like when they see it, and vice versa, people who have gotten a lot of offers accepted on what they're doing to make the strongest offer possible. So little things that you can take with you on that, but please ask questions about what you said. I can go blather on for hours and hours, or we can just have a nice chat and figure it out on that end. So yeah, that's the idea. Obviously, as it says there, the stronger offer you make, the more deals you're going to get accepted on that. And also just from your perspective, the more you know, I think it makes sense for building that trust with people. You don't have to know everything, but how often are you sitting with a buyer and they ask you something and you're like, oh, let me, you're kind of deer in the headlights. But if you just have a little bit of information, you know what you should know and what you shouldn't know. Essentially, that's like the biggest thing that I've learned in mortgage in general is I don't know everything. The more I know, the more I realize I don't know. And that's something like, I think as you get further along, you realize like, I shouldn't have to know that. Right? You don't feel like an idiot when somebody asks you and you don't have the answer for it. So that's kind of like the idea here on that. So obviously we want to avoid having a good, strong offer and somebody so strongly pre-approved. You're going to avoid a lot of the last minute nonsense, and also you're going to have confidence when you make an offer, and that goes a long way, as we'll talk about. So hi, Allison.
Hi, Eric.
All right, next one. Have a taco. All right. So 5 basic steps in this pre-approval versus pre-qualification. Just my opinion, a pre-qualification is kind of like somebody going online, shooting in their information and getting a letter out from somebody.com, right? On that. Really, you can put in any information you want in there and they can get a qualification, right? You can get pre-qualified. You don't have to tell the full story, right? A lot of times people will say, self-employed, and they'd be like, I make blankety blank a month, right? And they're like, wow, that's an easy qualification. Once you actually look at it, they don't make X amount a month. Their revenue is there, but they write everything off. So their actual qualified income is way off, right? So pre-qualification, same thing, hourly. I work 40 hours a week and I think I make 25 bucks an hour, blah, blah, blah. Well, turns out when they work over 40, they get 25 bucks an hour. Otherwise, they're making 18 bucks an hour and they really only average 30 hours a week, right? Or they just started it. So that's the kind of the downfall of a pre-qualification. So when you guys see that or you talk with somebody, if they say they've been pre-qualified or they share something that's been from online, might be something to just have a further conversation with. Pre-approval is kind of the next step, right? What I say with a pre-approval is we have a nice conversation, kind of like what you guys would do with a buyer consult, right? You really get to know those people. I always ask the question, right? What do you do for work? How are you paid? What is the minimum? How many hours are you guaranteed every week? That type of thing, and really kind of dig into it. And I'll also ask for the documentation. And it might be just where I review the documentation. And I'll do, like, say, if they're self-employed, I always get you the tax returns so I can calculate the income and tell you this is our qualified, your actual income that you use, but it's what we use. Same thing with pay stubs, W-2s, that type of thing. With that pre-approval, you run what's called an automated underwriting. It's basically, I take the information, we enter it in, we hit go, and it goes to Fannie Mae or Freddie Mac. And they kind of run through their program, and that's the automated underwriting approval. Okay, so it's got 2 sets of eyes on it. an automated set of eyes and my own on that. That makes sense so far? Awesome. The next thing, so third leg of that, right? A lot of people don't do this because there's a cost to it. But what we like to do is supreme because we don't want anybody to get burned. But we also want you to have as much confidence as possible, is we take the documentation and the application and information we get from the credit and everything, and we send it to our underwriter and have them sign off on everything. Now, I've been doing it for 15 years. I feel fairly confident when I do a calculation and I look at stuff and whether I can say, you're good to go. You know, that's what we used to do 10 years ago because we didn't have underwriters wouldn't do that 10 years ago. We started doing that. So that is something that's like the strongest approval you can get on that. Because an underwriter signs off on it, they're saying, this, I've looked at all the documentation, income, credit, assets, we're good to go on that. We back it up with a $25,000 guarantee and or an 8-day on-time closing guarantee, which we'll get into on a strong offer on that, but we always try to back it up so it's strong on that. Found that that's the best. It makes it really easy for me to call a listing agent too and say, hey, I've already done my due diligence. We're gonna fly through this. We can close whenever you need to, whenever the seller needs to on that. Any thoughts, questions on that aspect of it so far?
You ever had to pay out $25,000?
I've never written that check. Yeah, and that's something I actually tell buyers too, is I'll go through and I say, hey, we back it up with our guarantee. And I'll be honest with you, we don't write that check. And the whole thing about it is a marketing piece so that the sellers can have that piece of paper, put it under their pillow and feel good about it, right? But we're gonna do our due diligence on that, but we do actually do the due diligence, not just something that we throw out and then we figure out a way out of paying on that. We just make sure we do it, right? It's usually what I say is it's either an active client or an act of God that we won't close, right? So either or. Other thoughts, questions? No? All right. Don't be afraid to go grab tacos, even if you came in late. I don't mind. Tacos are good. All right. So once we get a deal in, we'll send in, take the full application. That's what I'm talking about with that full underwritten. Say we get a deal in, we'll review it. We'll get it into processing. They're going to do a lot of stuff behind the scenes. They're going to get it ready for the underwriter is basically what they're doing. They're updating any documentation that I didn't collect. Yeah.
So is the cost for that process?
Yep.
So like that they would pay up front?
No
Okay.
cost to them, cost to me as a loan officer.
Okay, gotcha.
Right, yeah. So an underwriter, their time, basically.
So you're.
Yeah, we cover that because we found it's worth it. It's worth it on that end, on that, yeah. So that's why you'll see some people, if you talk with another lender, and sure none of you guys work with any other lenders, but if you do, they may say, yeah, we don't do that, right? And it's because they would be on the hook for paying that fee. So there's a lot of people who get approved and never go forward, right? Which is fine. It's the same thing with reviewing credit, right? There's a cost to us to do that. It's a cost of doing business. On that, but they may never go forward, or by the time they go forward, we have to do it again, right? So it's okay, but we're willing to do that because that's just the way we approach business is we'd rather know and be able to give that confidence. Any thoughts or questions thus far? No? Okay. So back to processors getting all that information. They're doing all the stuff behind the scenes. A lot of things, verification of employment, pulling a tax return, transcripts. They are looking at flood certification. They're communicating with their title. They're working with the appraisal management company. They're doing a ton of stuff behind the scenes, a lot of stuff that I don't even know what they're doing, but they look busy when they're doing it. So that's fine. But then they get it prepared. They send it to our underwriters, right? They may be reaching out to your clients as well on that just as part of our team. That's what happens, right? So they get it out there, get it in underwriting. Underwriters really just kind of that final set of eyes. They're the ones who are the experts and all the guidelines on how it works. We're lucky with our underwriters. They will call us and say, hey, we're missing this. If we do this, this will work. This won't work. You know, so we're in other worlds. That's a scary proposition when it gets sent to underwriting because you don't know what's going to happen. Like you're flying blind sometimes on that, but we're lucky on that. We've got people that really want to find a way to get a deal done no matter what. So ideally, I've done my job on the front end and their jobs are super easy, but if I do miss anything, I've got strong backup on that, but that's what's happening after you send in your contract, on that. So, let's see, after that, underwriter gives conditional approval. We may be waiting for the appraisal. We'll maybe waiting for insurance information from them. Some other things that they might be waiting for. We're gonna verify the assets, the final assets. We have to verify the employment at the very end, that type of thing. That's why it's a conditional approval. Essentially, it's gonna be a much narrower list of things that we have to cross off and do. Okay? Then once we get all that, usually 10 days prior, we are submitting it for clear to close, which means the underwriter signed off on everything and we can get it to the title and closing to do the final numbers on that, and then we send it to the client. Obviously, throughout, a good loan officer is going to be updating you throughout. They're also going to be updating the listing agent so that you don't have to worry about that. So if you're calling the listing agent, they're not going, I haven't heard from your lender, what's going on, right? That's just a mark of like somebody who does their job, right? On that end, and that is part of my job, is to keep everybody updated. Your clients should know what's going on. I personally try to reach out to you first and then your clients, just in case you have a question or if you want to provide information that I don't, whatever it might be, right? So that's kind of the way I roll, is you, client, listing agent, title, insurer. Try to do that on a weekly basis. A lot of times the update is nothing to report, but at least we know we're moving forward. We have no issues that are popping. And that's, I think, the least you should expect from a partner. So you're not just throw it in there and say good luck, you know, and then hopefully we get a check at closing, right? So thoughts, questions, anything like that? No? Okay, perfect. And then you get the clear to close. That is literally what it sounds. We're clear to close. On the day of, we do table funding in Minnesota. So the funding gets released either the day before or the day of. You get to closing. There's a check there. You don't even have to worry about it, and you get your check from the title. So, all right. Let's see. All right. Most common loan program, conventional. That's your Fannie Mae and Freddie Mac. 2023 was 73% of all mortgages were through conventional financing. I think in 2024, probably along the same lines, if not a little bit higher. I kind of expected that 23 or those 73 to be a little higher in 23. A lot of people are afraid of anything they don't understand, and a lot of people don't understand anything but conventional. For whatever reason, that's the simplest one out there. People have fear of the other ones. But another great program, especially for first-time home buyers, but it's not only for first-time home buyers. It can be a great fit for somebody who maybe doesn't have high qualifying income. They allow a little bit higher debt to income ratio. That's a comparison of your debts to your gross monthly income. The debts that we look at is obviously the new mortgage payment and all that entails, right? Installment debt and then revolving debt. Installment debt is anytime you take a lump sum of money, you borrow a lump sum of money and you pay it back over a specified period of time. That's an installment debt. Car loans, student loans, mortgages really are, but they get their own category. Personal loans, that type of thing. So that's installment debt. We'll use the minimum payment on that, even if they're paying more, right? Revolving debt, that's your credit cards. That's anytime you get a line you can spend up to and pay it down and spend it back up, boom, boom, boom. We use the minimum payment on that, right? So that's what goes into that debt to income ratio. FHA, yes.
If you have a credit card but no balance on it, does that count towards your revolving debt?
Yeah, so when we review credit, it depends on what's been reported to the credit bureaus. So credit cards all report on different days. If it's a zero balance, you get a zero payment on there. So you'd be hitting with
You had a
zero.
$20,000 credit card, but you had zero on it. Would that count as credit?
Zero, yep. But if you say you pay it off every month, a lot of people do that, right? They use one credit card and pay it off.
Yeah.
We don't hit you for the full amount, right? You could have 20 grand on there. We're gonna do the minimum payment on that. Same, good point though, with qualifying, you guys really don't need to know this, but you can pay credit cards off at closing to qualify. So I always tell people, don't hesitate to talk to me and get an application going, because a lot of people are like, I want to pay down these credit cards, I want to do this, I want to do that, right? Paying down a credit card can be a good strategy to improve your credit score. Hi, Paul. You can improve your credit score, but it doesn't have to. If you're good where we're at, we can just mark it to be paid at closing, right? Or you can pay it down. So there are ways around it. So your clients, if they're hesitant, one thing I found is people are excited to talk to you all because you guys are talking about real estate, right? You guys, what do you do for a living? I'm a real estate agent. Ooh, what is my house worth? What is that? Where, what would that be worth, right? Jack can probably attest to this. What do you do for a living? I'm a loan officer. Oh, cool. Walk away, right? Nobody asked me about anything. A few years ago, we were very popular. It was really cool because rates were, I mean, there were other things going on in the world that weren't as cool, but I was popular for once, so that was nice. On that, but I don't know where I was going with that. Either way. So yeah, people are afraid. Honestly, the reason I think it is, even if they're well qualified, people are sometimes hesitant to share their information about their finances. So what I always ask my partners to do is just let them know I'm not going to push anything. I'm here as a resource to answer questions on that type of thing. Don't be concerned if you have credit card debt. I promise you, I've seen worse situations. Not for you guys, you don't tell them that, but I have seen worse things than whatever your clients are doing on that. So been doing it long enough where I've seen a lot of painful situations for people. And honestly, one of the things I like doing is helping on that end too. So talking through what that looks like, how do we pay it off? How do we improve credit if that's what we need to do? If we have to budget better, we can talk about that too. So it's really kind of that thing. So just like, that's one thing that I always try to stress is let's talk first and we can figure out a solution for them. Don't be afraid of it. We can help. But regardless, FHA is a great thing on there. There's some fear on FHA, VA, even USDA, because they're government backed. People are afraid of the appraisal, right? They're afraid of the appraisal issues. Really? As long as you don't have lead paint, chipping lead paint, and huge safety issues, you're going to be fine. Pretty much anything can be fixed. And frankly, everything on conventional will be called out as well if it's a safety issue. So you're really not harming. Go ahead.
So a conventional loan things could be called on an appraisal.
Yes.
To have to be repaired.
Yes, exactly.
So the appraisal is always going to the lender, not the inspection.
Correct. Yep. The appraisal report comes to us. We don't look at the inspection whatsoever. So the inspector is going to go a lot more in depth because they're proving their value, right?
So what's an example of a safety?
Simple as not having railings.
So I was just walking with clients and then old home in South Minneapolis, and they had put a new wrought iron like around the loft area as they're coming up the stairs, but they're this wide apart.
Mm-hmm.
And I was just like, if she's FHA,
Yeah.
it doesn't matter, that would have to be fixed, or not necessarily if there's not children
It's
there.
not necessary.
Okay, so that's
Okay.
the question.
Yeah, it's a question. Most appraisers are going to work with you on stuff like that and say, okay, hey, just do this to fix it, kind of thing. Like maybe
It could be closed?
even, yeah, as it's going out there, if it's an issue where it's really dangerous, the more thing is they say there's railings not there at all,
Right.
right? Where you're off the edge, right? That's a problem that will have to be fixed before.
And with a conventional loan.
Conventional loan, they may or may not click it on that one.
I had a conventional recently and there was no deck on the second level. And there was a deadbolt there,
Yep.
but under appraisal, they didn't like it. And I said, all right, I can put a key deadbolt there.
Sure.
And they're like, no. And I'm like, what do you need? I can screw a board across the thing. So I removed the trim, screwed a 2x4 up high, down
Right.
low.
That used to happen a lot more.
Yeah.
Yeah, a lot of times they want to see it blocked, like perfectly blocked on that one. That used to be a real big thing, probably 10 years ago. I saw so many new construction ones where we're fighting with the appraiser about that exact issue.
Yeah, on new construction, there's a lot of.
Yeah, most people are right. They don't build the deck when they build the house. So that can happen. It doesn't happen as often anymore. But again, the solution is put in a block on that, right? It doesn't have to be permanent because people, it's going to ruin. Don't do like you did. You remove the trim or whatever, or you put a block in there and show that nobody can open it and fall to their demise. Yeah. Oh, so you could have to do it that way. Yeah, definitely.
I don't know if you're gonna get to timing of all this,
Mhm.
but last one that I closed on, we struggled with, like meeting our close dates
Mm.
because of the appraisal and, saying this. and
Needed
that.
a bunch of things.
And to me, it was a very clean house, so it was picky.
Yeah.
It was like, do you, like, up front, should we, like, have a general sense of, like, especially these South Minneapolis homes, like,
Mhm. You're gonna,
be a timeline thing that we need to, like, really be sensitive to and say, like, let's not try to do a 21-day close, or, like, what do you?
yeah, no, for me, okay, so if that were my client, I would order it right away. Appraisal should not be in here. No, they're not busy enough to make it a problem of hitting a 21-day close. Like, that shouldn't be an issue in my opinion. They're not busy enough.
I thought I was making it really tight.
Oh, God. No, like, well, I mean, I was talking to people this weekend and I offered 4 different people, let's close by the end of the month, easily. One person took me up on it, but we can, 21 days in this environment should not be too long. Like, we do a guaranteed 8-day close. So not a thing that should be.
But how do you, like,
But-
fix that?
Yep, so you get it in and you have a conversation. What I would suggest is like the buy side agent, or the listing agent, you call them and have them call the appraiser and chat with the appraiser. That helps. Cause then they'll work with you on certain things. But if they call it out, it's just, we get it and we deal with it right away. So it shouldn't be a timing thing. From my perspective, I don't know, like, that would frustrate me. Sorry, I would imagine, I'd be very frustrated. And that's, again, we're lucky, we've got a panel of appraisers that we trust that are not gonna cause that issue. And it's lucky, just because we're local, we can build those relationships. Obviously, I can't influence anything, but I do know the people that are working. And they'll call our office and say, hey, this is an issue, this is an issue. Okay, let's fix it, right? And get you back out there and get it so it doesn't impact the closing or the clientele.
The repair can't be done.
We'll do what's called an escrow for completion.
Conditional.
Yep, so what we can do there, it depends on what it is, right? But that's an escrow for repair, so.
So that, again, raised, because that was.
So it's usually 1.5 times the amount.
So you get a bid, what that is, and then I'll answer your question. So if it's something that can't be done seasonality, right? You can't do it because it's too cold or whatever the reason is, you'll get a bid for whatever the fix is. And they will set aside 1.5 times that amount to be paid after closing out of the fund, whether the seller pays it or the buyer pays it. Either can do it. Ideally, you're having the seller do it. So they've got some skin in the game, but I've seen it where the buyer says, I will do it after the fact. But then we do it once you're able to do it. So we hold the loan until that happens, and then we get it done. That money is refunded to either the seller or to the buyer, minus, even that 1.5 time, the whole amount goes back to the buyer. We pay that person who's doing the work, and then the remainder goes to the seller or the buyer. The 1.5 is just in case the bid is too low, doesn't get done on time, whatever the case may be.
Answered it. But, so there's, that doesn't, maybe because you're working with your, I was like, so our client picked their own lender. Like,
Of course, yeah, it's terrible to say.
And that lender said, no, we don't want one of those on an FHA loan because that's gonna be a red flag for closing. And so it's like, where's that fit in? Is that a thing?
Yeah, it's what you have to do. Like, if it's FHA and that's the best thing for the client, we will figure out how to get it done. We can escrow for completion on FHA.
Okay.
We can say, hey, seller, you want to get it done beforehand? Cool, send me a picture, we'll get it done, right? So there's ways around it.
But can it be a problem with the FHA?
They won't do it. If it can't, like, you can't close on it if you don't have a plan for it.
Right.
Like, you can't just like ignore an issue that's called out on the appraisal. The other thing about an FHA, and this is why people don't like it, is that FHA appraisal sticks with the house for 6 months. So if another buyer comes in with an FHA, say your buyer fell off of that, and another FHA buyer comes in, that appraisal is what they're gonna do. That value, those issues, anything pops up. So that's one of the draws.
No matter who the lender.
Yeah, it's because what happens if say I were gonna help somebody who is FHA approved with somebody else, they had an appraisal on a house, I can actually get that FHA appraisal transferred to me. How about?
With that question, or with that answer, how about other appraisals? How long do they stay on the books or does?
So if it's a conventional appraisal,
Yeah.
that is, between the lender and the client, basically. So that's for the lender. On that, if another person come in, if I'm gonna take over a deal there, we would have to do a new one. A lot of times what we'll do is we'll reach out to the appraisal. If it's a good appraisal, we'll have our appraisal management company call them and say, hey, you wanna work for us? We'll reissue a new appraisal, but they use the same word, essentially.
What if it's an independent, like, if it's moving from one person's name to another and they had to have the.
It has to be ordered by the lender. So, is that the question, like a client did it, or?
I have a client who had their house appraised because it moved out of the trust into the girls' names.
Yeah, that's for them. So it's independent of the transaction. Yeah, it's transaction specific. They can't order it and say, hey, use my appraisal.
Okay, good.
It's just basically a matter of control for the lender, right? They want, because they're gonna lend on this home, they need to be able to say, see, it's marked, and we have a whole separate underwriting approval for the appraisal itself. So that's why they do that. Other thoughts or questions? I didn't know appraisals. We're gonna have an appraiser in, our AMC guy, who is the head of that. He's a cowboy named Bart, and he's awesome. So next month is the goal. So hopefully y'all can come in, and he'll be a wealth of information about appraisals. Like, you can ask him literally anything, and he will give better answers than I could ever hope to, and be way more entertaining. So please put that on your calendars for sure. He's awesome. Let's see, other ones, obviously VA for veterans, not specifically for veterans. In the case of like a spouse whose spouse had passed away in service, they can also be eligible. Traditionally, it is for veterans. Yeah,
Can a person do, I thought there was something that a veteran could only do one VA loan in their life. Is that true?
they have VA eligibility, so they can reinstate their eligibility and purchase another home on that. So, yeah, there are ways to use it multiple times.
But if a VA assumes part of their loan,
That's taking up a portion of their eligibility. Yeah, exactly. And then they only have a portion of their eligibility left. It just changes the calculation as how you do it. So, yeah, so if they let somebody assume it, that's one of the drawbacks of letting someone else assume it, is you lose a portion of your eligibility.
Does a VA loan have to be owner occupied?
Yes. I mean, once you leave, I think there's rules on that, but you can't buy as an investment property.
Even the veteran?
No, the veteran, no, yeah, it's only for primary residence.
speaking of, on assumptions, can you talk a little bit about that? I know do you see quite a bit of it, or?
I see people putting them out there a lot. Do they happen often? No. In my experience, and here's my thought process on this, is a lot of times it's really advantageous rate, right, that they're offering, right? I have an FHA or I have a VA loan at 2.5%, right? From a lender's perspective, why would I give you that 2.5% when market rates are 6, right? I'm losing money on that now, right? It was a good deal when I made it, and I'll keep going with that. So lender has to approve it first off, like the servicer of it has to do it. The other thing that people are running into is you have to be qualified by that lender. The buyer has to be, plus they have to make up the difference of that, of what it is. Say you're buying a $500,000 house, there's a $250,000 assumable mortgage on there. You have to make up that $250,000. How are you going to do it? You can, it has to be approved by the lender that are going to allow you to do that. So if you have the cash, that can work for sure. But again, the lender has to approve you. If they do that, it usually is just more of a sounds good marketing thing that people like to put out there. I haven't seen it come into play as much. I mean, for the right person, it's a great deal, on that if you can get it. It just, in my experience, it's been floated out there and then never.
I had a seller who was trying to do that, and the lender was such a pain to work with to try to nail down
What would do it.
available or what the criteria is.
And that's been my experience too, because from a lender's perspective, I can't do anything to help. It's all up to the servicer of who has it now, right? And usually it's a call center, and it's people that are like, you don't really want to do this, so let's make some extra steps for you to do it, right? Or maybe we just won't respond, So it's unfortunate on that, because it is a cool aspect of both FHA and VA, that it can be assumable, but unfortunately.
The strange thing is, you think they would want to retain the business, right? Because it's gonna get sold, so
Right.
it's like either you're gonna, chance of you having it again is slim.
You think about it when it's like, if you had a small portfolio, yes, you'd want every single one. But when you're talking large portfolios, a lot of times they're saying, I'm taking in payments on this 2.5%. Whereas I could spend my time taking in payments on a higher bit and resell it, blah, blah, blah. You know, so a lot of times it's like, we'll keep doing it because it's already set up with you. Getting a new person in, I'm taking on new risk, I'm taking on new liability, but making the same amount. So that's kind of the idea.
And a conventional loan is not
It is
assumable.
not assumable, no. All right, and then the other ones, USDA is rural, so you have to just look it up. It's outside the Twin Cities area. I think it's as far out as like Belle Plaine it works, some western places that y'all would work with. You just look it up. It's great. It's 100% financing on that. It can be a really good, they're a little strict on their debt to income ratios, but they're great. Jumbo,
And
that's.
that again, that can be a single family home in a
Yes,
neighborhood.
That is a single family home. In a neighborhood is just so the area is considered rural by the USDA. And so it's really simple. You just look up the address and it says it is or it isn't. Yep, exactly. Yep. Jumbo is above conventional limits.
Do you know how often so I know how to look it up.
Yep.
And I was curious because I live right on the fringe
Oh,
on the eligibility side.
Sure.
But at one time it wasn't where I live,
Sure.
and then it was, and then those boundaries, do you know how often they switch?
I don't.
I mean, I know how to look it up and it's a pretty
Yeah.
simple process, but I just don't know what their
I think
line
they
of thinking.
Yeah, I think they address it every year, but I'm not 100% sure.
Okay.
I really don't. I think it's kind of like the FEMA maps, which is the flood maps.
Yeah.
I do it sporadically, but it
Yeah.
seems like every year, kind of, but only when you really count on something. Then it flips. So,
Yeah.
not
We
that.
had that where it was like, this was eligible a year ago,
Yesterday,
and then
yeah.
now it's not, and vice versa.
That's where with USDA especially, because they're also one that is a little more sensitive to like, say, a government shutdown that's coming down. You have to make sure you have your committal in there ahead of time. Because if it's shut down, you're not going to be able to get anything close. I don't care if you're already pre-approved and all that, you have to have the committed funds on there. So USDA is kind of a tricky one where you want to keep an eye on it constantly, basically. If you have a deal with that, like your lender needs to be on it, for sure.
I had a question that also, I have a client just looking at a hobby farm.
Sure.
Which I assume the
Mhm.
possibly in that rural area. If she has a pretty decent down payment, would there be any reason to still use that or not?
Sometimes the rates are better. Depends on what it is. I would have them run it both ways to see if it fits for that person. Just take a look at it, see if it fits on that one. I don't do a ton of USDA, so I'm not an expert in that area. But I would always run it and take a look to see comparatively. I've seen the rates be better. There's a funding fee on USDA that offsets. So that's where that benefit is, where you don't have a huge down payment. You can finance this funding fee. So that is the bigger benefit, but a lot of times they offset that with having a little bit of better interest rate, right? If you have a big down payment, it's probably not worth it, right? It could be, but it's worth taking a look. Jumbo financing, anything above 806, 500, that's the new limit on that one. Essentially, the difference with jumbo stuff, more down payment, essentially, is what you're gonna need. True, you can do 15% down, rates are pretty jacked up. On that, they're really pushing 20, 25% down on that. So but can be some great programs out there. Just looked at something that was, I think an ARM, 7-1 ARM for like 6.125 with no points. Like, so just like a really good aggressive rate right now. Comparatively, right, we're looking at 6.5, 6.625 for a conventional loan with a point. So there's an appetite right now for some of that stuff out there. So just interesting. People that don't fit into any of those categories, you can do what's called non-QM. That's a bank statement, P&L, that type of thing for self-employed borrowers that have money coming in. They just don't show it on their tax returns. You're going to pay a higher rate for that, but it can be done. DSCRs for your investors. That's where they have a big down payment and they're using the debt service on that to justify getting lending on that property. So it means basically does the rent pay for the new financing on it? That's all that is. So let's go to the next one. Issues that we addressed a lot of these already on that. Yeah, really. There's options for credit. There's options for down payment. You know, you can get down payment assistance. We can fix your credit. Pre-approvals do not have to take forever. Really, even when we do our full approval, we'll get it done 2-3 days. If the client gives us our stuff, we'll get it to you in a day, 2 days, whatever it takes.
What, is there like a minimum percentage for a conventional loan for a down payment?
3% for most first-time home buyers is the minimum. Most times I prepare people for 5% because that's based on income,
What if it's not a first time home buyer?
5%.
5%.
Yeah.
So anyone could do a 5%?
Anyone can do 5%. Yep, I've
on
done that a lot of times.
conventional
For example, a lot of times we'll do, somebody isn't selling their home before they buy a new one.
Mhm.
So they don't have a ton of cash. A lot of their equity is, stuck in the house. We'll do a 5% down on the new purchase. They'll take the proceeds of the sale when that happens and recast the loan. So they get keep the same rate, but they'll get better terms or fix their payment on there. But they can buy with 5%. So that way we can do a non-contingent offer on that.
Kind of fees are in
For
the
recap?
casting of that.
Usually it's dependent on the servicer, but it's usually like a fee of like $500 and you have to do a minimum of $10,000 on that, because they don't want you to do it a bunch on that end.
Isn't it pretty like a certain period though?
Depending on the servicer. Usually normally they prepare people with like, be prepared to pay $500 on that, because like they have to process it essentially. So I always tell people it's probably going to be $500 on that. So, all right. Let's see. FHA, VA, they're not weaker offers. In fact, if you've done your due diligence, you've done what you're supposed to do, FHA can be as strong. I've had a lot of people that, a lot of times I'll present the buyer as both approved for conventional and FHA, and talk to the listing agent and say, hey, FHA is a better fit for it. Let's talk about the property. Let's get it going there on that. So it does not have to be a weaker offer. A lot of times it's because people aren't familiar with them, and what we're not familiar with, we're afraid of. So, yeah.
Down payment assistance program.
Mhm.
First time home buyer program.
Yep, definitely. I was going to talk about.
We run in time.
All right, you're excited. I get it. No, so a couple of things that we run into, obviously, is a credit score. We can go as low as 580. Not great terms at 580, obviously. The lower your credit scores go up to 850. So 580 to 850. Generally speaking, perfect credit is 760 and above on that. What happens is it's every 20 points, essentially, terms get a little bit better. So at 600 is a little bit better than 580, and so on and so forth, all the way up there. Most down payment assistance programs are going to require at least 640, if some 650 or 660, depending on that. So the higher, the better. So what I always do with a credit score, if we've got a low one, Jack does this too, Julian will do this as well, is analyze the credit and look for ways to improve it. Improving credit can be as easy as paying down some credit cards, sometimes opening a credit card, getting added as an authorized user. There's a lot of different ways to improve credit. Some take longer than others, but you can do a plan to get people where they need to go on that. Like I said, we can do 580. Usually I'd say that's a short-term solution. You really got to buy for some reason right now, and I've done it. Because sometimes, to be honest with you, credit is low for a reason. It's probably going to stay there. So 587 might be the best score that they're going to have. So let's work with that and let's figure out how to get home ownership and fix it going forward, right? So that's just something, that's what we run into with credit score. Should always just take a look at it, analyze it. A good loan officer is going to help your clients with it. It may not be right now, but it can be done, right? So, yeah.
How do they decide, the credit score? I mean, I've had it myself. I've had clients that have experienced this where, Equifax and what is the other, TransUnion? And yeah, like where there's like a 40-point difference between the two. Do you just average it out, or do you?
What we use is the lower middle score. So say there's two borrowers, each gets 3 scores. We use the lower middle score. If it's one borrower, we just use the middle score. So it's kind of that average of the two. It depends on the situation, but yes, I've seen like TransUnion be 40 points higher or 40 points lower, just because their algorithm's a little bit different. It can be for different creditors reporting at different times, or different information being reported to them that some may be incorrect, some may be correct, and that can equate for that. But it's the different algorithm that they use to calculate this. Okay. So, but that's why they use a tri-merge. So you basically have the average of those. Right. Other thoughts or questions on credit?
Is this really, this first time versus that what you're showing?
For what? For,
Down payment assistance?
there's a few programs for non-first time home buyers. They're not as great. Yeah, but this is generally first time.
If you haven't owned a home for 3 years or more.
Correct. Yep.
You qualify. for
You are,
first-time buyer.
you are considered a first time home buyer.
You haven't owned a home for 3 years?
Yeah, that's all it is. So if you owned a home, sold it, and then you decided to rent for 3 years, you are now a first time home buyer. Yep. I've also seen it in cases of divorce where a single parent will come out, and they weren't on the mortgage necessarily. There is an argument to say, all right, they're now a single parent. There's some criteria on that. It's very smaller percentage of people that get to use that, but that can be done as well. But yeah, 3 years in any situation you could have owned previously and be still considered that. Now you can't be like, say you're married and your spouse owns a home and now in Minnesota you've got marital rights to it, you're no longer a first time home buyer. You would have to separate and then do 3 years. All right. Yes, so down payment, that's one of the big things, right, that people have issues with, along with qualification. Good question earlier, it can be zero. We have zero down. That's VA, USDA. Those are a couple programs there. Minnesota Housing, it's a little as $1,000 out of pocket for clients on that. They use the down payment assistance to make up that amount that they have to put into the funds on that. So there's a lot of options there. Let's see, can access gift funds to get through the down payment. A lot of people don't know that. Employers can give gifts to clients. Usually though, it's a family member. Not that we can do that. Let's see, down payment assistance though, MHFA, great statewide. So that's Minnesota Housing Finance Agency. They do it statewide. It's all income based essentially.
Is it a loan?
There are 2 ways to do it. So there's one that is called a deferred payment. Acts more like a grant because you don't have a monthly payment on it. But if you go to sell or refinance it, you have to pay that amount back. So that's something I always talk
Just
about.
like, is that one like, for if you stay in the home for 20, 30 years?
It's not forgiven, no.
It's not, okay.
That's one you say it stays with you. Yeah, there's.
Does it get tacked at the bottom of it and then you pay it off, like if you're in there for 30 years and then,
And yeah, I mean, if you never leave the house.
Yeah.
You never pay it back.
oh, I see.
Yeah, so,
Okay,
I haven't seen it. I don't know that one. I don't know. No one's ever told me like, hey, I stayed in this house. I haven't been in the business that long, so I don't know, I guess, for my
If you
clients.
sell it, all of a
But-
sudden that would pop up.
Yes, it's a lien that goes against the house. So there's 2 of them. It's on everything. So when they do the title search, it's a lien. Have it a lot of times where first time home buyers will buy it, build up the equity, pay it off and refinance, right, on that end. So it takes.
Colleen and I ran into this one where, the deferred payments during COVID, our recent seller had 2 liens on her property that she forgot about, of course. So she thought she was gonna get this much back, and then it was like 2 extra loans for deferred payments during COVID.
Yeah, I've had a few of those too.
Yeah.
I just did a cash out refinance for somebody and paid off the deferred portion of that and been able to do some other
And you can
stuff.
never forget it.
So,
So is this as you as the lender, do you like look into these things for every person?
yeah,
Like what might work?
so ideal, yeah, so that's 100% what you should do. Like every time I chat with somebody, I have a list of questions that I ask, and one of them is, where are you looking, right? And then we talk about the 3 pillars of lending, which is credit, your debt to income or your employment, and then your cash flow, right? So I always say if you have 2 of the 3, we can figure out the other one. But that is what cues me in to say, if I know where you're looking and I know you don't have X amount, more than X, we can look at these programs.
Because there says Minnetonka.
Yeah.
So cities can have.
Yeah, so that's the cool thing about it, is there's different cities, counties, they can have different programs. There's different nonprofits within the Twin Cities that'll do stuff from time to time, and they always change. And they do a poor job of marketing themselves. That's
So
the
you
key.
know
So,
these things and you invest.
I know most of them. I don't know all of them.
Yeah.
I don't know all of them, but I'll look. And then I do the search. And I've also had clients say, hey, I heard about this. We look it up because we do so many of that, we can do or get approved to do pretty much any on there. So yeah, that's a good thing to note is it's not just like, so MHFA may not work for everybody. This Minnesota, like for instance, this Minnetonka down payment, it's $50,000, 0 deferred. It is actually, I think every 5 years, it goes down by 5% of what you owe, right? After 20, it's forgiven or something like that. It's zero payment and it's up to 120% of the average median income. If you have somebody looking in Minnetonka, which I know there's not a ton of homes available there, there's some correct criteria on it. It can't be a purchase price of over 485. They have to be first time home buyers, that type of thing. But amazing if you have somebody that fits, perfect, like 50 grand. They don't have to pay anything on it. If you're planning to move to Minnetonka and that's a long-term house, right?
How trucks still have theirs?
I don't. Sorry.
So we just go to the county, because when you're speaking to people, sometimes they want to do their own little research.
For sure. You said Google. It's a great tool.
So, but what are we Googling though? Just.
Down payment assistance blank, wherever. Down payment assistance, city,
Okay.
Hennepin County, Ramsey County,
I
wherever.
think there's a great master resource right now.
Oh, there,
Do it, you're talking about, just go to their city website.
yeah, just take a look and see what happens.
City, not county.
Yeah, city or county, because Hennepin,
County, but yeah.
yeah, I would do where your client is looking. Like, Blaine has a good one. Like, there's a random, like, you'll find this is housed at the Center for Energy Improvement and Environment or something like CCCE. There's ones for St. Louis Park on there. There's like, but I don't know why it's there. You know why it isn't other place, but they're managing it. And I've chatted with the person who runs it. She's awesome. It got deals done. Jack did one for somebody. Put it with Minnesota Housing and got like 50 grand for that.
20% down, drop mortgage insurance,
All through just being
loans forgiven in a couple of years. That's just gonna happen forever.
yeah, tons of options out there. You just use Google, talk to your people and say where they're looking. And then I always like to research. I learn about new ones all the time, trying to get out there.
Maybe I'm wrong. All of them I've seen are owner occupied, right?
Most are, yeah, most are. All these programs are trying to encourage, right? Just like you guys have heard about the first generation buyer, right? That's another one, a program. FYI, if you guys have anybody who's considering the first time or first generation, get them approved now and have them. It takes 6 to 7 weeks to get an approval from the MDCC who runs it. So 6 to 7 weeks, they have to have a full approval from a lender. Then they can apply for the program, and that's taking 6 to 7 weeks to get their approval for the funds. Then they can start looking. And then it takes 60 days. What's that?
Are they starting to pay that out yet? They had told me that they're kind of holding funds, paid it out.
This one is still active and has been active unless I'm wrong. Have you heard anything weird on it?
Oh, I've been seeing people getting reported.
Yeah. It just takes a long time. Like it's literally 6 to 7 weeks to get approved. And then once you get a contract, it's 60 days. They take that long. It's not the lender's fault. Usually I like to blame other lenders, not the lender's fault on that. That one is up to 32,000. So that there's some caveats to it as well, but 32,000 is a great one. That one is forgiven over time too. It's a really great program that you can get into. It just takes a long. So if you got anybody considering it, get them to talk to a lender, get them in there, apply. Is first generation buyer, that's how you'd have to look that up. Any thoughts or questions on anything else? So it's just key to know where your people are looking, do a little research if down payment assistance is something that they need, right? And it can be too. People will come to you and say, I've got 20 grand. Okay, cool. Let's see if we can add to that and supplement your funds. You can supplement a person's funds. They don't have to not have it. They can contribute. I've used it before, like Jack just said, to get to 20%, right? So no mortgage insurance puts them in a pretty strong position. They can qualify for more house because they don't have to pay mortgage insurance, right? And their monthly payment is lower. So it'd be a huge opportunity. So next one. Time is going really long. Sorry. Guys, if you gotta go.
I think we keep asking questions, so I think it's all
Okay.
been helpful.
All right, cool. Yeah, I will stay here and answer questions as long as possible. Any other questions on that? Guys? No? If you think of something afterwards, please feel free, let me know. Talk to your friends. They have questions. They can also ask me. They're really. All right, so the other thing I wanted to talk about is just making a strong offer on that. So I've talked with a few, like I said, listing agents, to folks who had some offers accepted, different strategy, how to make your offer. Right? Obviously, Obviously, if I'm a lender, I think you gotta have strong pre-approval and or approval with that. So it's giving you confidence in the offer. You make it out. Nobody wants to fire out an offer that you're like, I don't know if we want this accepted. I don't know if this is gonna go through, right? So it's have that strong property specific. What I mean by that is lenders should hopefully take a minute, look at the property, look at the property taxes, and see what does it look like. I try to ask people, what do you think from you guys give me a client, I'm gonna ask you to say, what do you think we need to get this deal? How high? So I'm gonna show the client, here's the range of the purchase price. So when you go into that house, I want them to be comfortable to know that one, they can qualify if they have to go over ask, but also what does that look like from a payment and cash to close standpoint, right? So that, but it also gives you confidence when you're making that offer. You know, my client has gone through it with the lender, they're comfortable with the terms, lender's comfortable with the buyer and the property. We're going. So that's a big thing there. And again, the confidence will come through. I'll just skip to the communication with the listing agent. Every listing agent that I've talked to, it's about the confidence that either you and or the lender present to them, even if it's via voicemail, right? You give them a call, you say, hey, here are the terms, blah, blah, blah. It's great because you have to ask about, what's the buyer comp situation anyway, right? That communication gives you an opportunity to ask the listing agent, what do we got to do to get this deal done, right? Paul, can I use your experience? This weekend, Paul was hammering this listing agent back and forth because his clients really wanted this house. He talked to him, 4 or 5 times on Sunday. And eventually, I told him what we need to do to get the deal. And then he got his clients their house that they've been eyeballing for 3-4 years, right? In the neighborhood on that. And it's all because he built up a rapport with them. And then the agent was like, all right, here's what the sellers want. Your clients can do that, we can get it, right?
I can testify
Yeah,
that he's done that more than one time.
believe it.
He's had offers accepted that haven't been the highest amount, just because of between.
Exactly, and that would be my next point too, is not always the highest offer that gets accepted. Sometimes it's the flexibility in terms. What does that mean, right? When you close, is it pass fail? Do you have somebody walk in while they're viewing it, right? So you don't even have to waive an inspection, right? Is it the written statement date, right? You can say refunded to seller. You might want to talk to Kevin about this, but believe you can say it's refunded to seller, and up until midnight on the day of the due date for that written statement, you can back out of the deal and get the earnest money back for you. But from a seller perspective, they're going, these people are serious, right? They're going to give me the earnest money because they want it. They don't see it falling. You're protecting your client, but you're also making good offers on that. A stronger, a bigger earnest money can show higher down payment. Something to know about down payment. You can present a down payment that's higher than it actually and as is when you lend. We get to closing, we can change the down payment on that. What I always say is the seller doesn't care where they get the money, whether it's from your account or the bank's account. At the end of the day, they just want the check. They don't even know, right? So if you make an offer, you make it in good faith. It's 20% down. The client thinks they're going to do 20% down, right? Well, we can change it. We've got some flexibility. We can go 15% down. We can go 10% down, right? 10 to 5, that happens a lot. Sometimes people are just, right? You make it in good faith. You don't want to be coming out and saying, I'm going to put 50% down, and then all of a sudden it's not, right? It's the same thing. Like you're going to make a cash offer when you don't really intend to make a cash offer. That's not great, right? Now, if you make a cash offer and then you tell, hey, cash is going to be back up and then we can do lending. We do that all the time too, right? You get the offer accepted as cash. They show proof of funds, but they're going to explore financing. You know the offer is still good with the cash, but you can get financing again. Again, the seller doesn't care where the money comes from their bank account or the bank's bank account. They just want their money at closing, right?
Drink to that is to still make it.
Yeah. Oh, yeah, yeah. Right. You don't want it to get contingent on
We
financing.
were terrified because we were switching it.
Yeah.
Not sure how they were.
Really, we
It was a very high
smoothed it over. We smoothed it over. Yeah.
Meters going on for years.
There is a 40-year out there. It's 40 years, 30 years, I mean.
84 months on a car.
Yeah, exactly. Yeah, you're getting a little lower payment. I don't know. I think they offset that with a higher interest rate though, too. I don't know. We don't have it. I don't do it. I kind of stick with the traditional stuff. You can also do a 27-year mortgage if that sounds good or whatever. Essentially, you're just amortizing it over a shorter period or a longer period. The same amount.
30 years.
Yeah, 30 years is pretty standard across on that. And those terms usually wouldn't get shown to a seller anyway on the length of time. As far as I know, like over 30 years. I don't, do you put that on the purchase agreement? I would be honest, purchase agreements, I have my points that I look at. I don't look at everything else on there. The thing I need to know to make sure that I'm doing it right. So I don't know all of it on there. Let's see. But yeah, the communication with the listing agent is huge. Be the confidence, have the flexibility and those types of things. That is what has gone. Again, you still have to make a strong offer. Obviously, you don't have to be the highest, right? But you're probably not going to come in well below the asking price or anything like that because you're best. Like, sorry. Maybe Paul's pretty smooth, so maybe he can do it. But no, you guys are all great. But
The first generation homeowner, that is 60 days. But that's not gonna be a strong,
but again, so yeah.
coming in at a higher,
But you have a confidence, right? So hey, we're approved. We're good. It's just a time frame, right? And some sellers, they don't care. They don't want to move in 60 days. They don't want to move in 30 days, right? So I would come in and say, hey, here's what it is. You communicate with them. And guess what? We've already done our due diligence. So from a lending standpoint or a financing standpoint, it's a rock solid deal. This is our time frame, right?
Does the seller know when you get down payment assistance or first generation or is that somewhere in there? Do the sellers know that?
On the purchase agreement, you mark that they needed.
And that's where ideally I'd lean on your lender, call and say, hey, here's my experience with down payment assistance. Here's what we've done. Make sure that this is not an issue. It shouldn't be a fear for you. In fact, we have to go through extra steps to make sure this is solid. So it should actually make you feel a little bit more comfortable.
Sellers actually appreciate, the first generation, as long as the offers are competitive, they like to know that they're helping someone.
Yeah.
Gain that potential equity in.
Well, it's the same thing of like telling the story of who the family buying it versus an investor. A lot of times, if all things are equal, most people are going to lean towards the family or the individual, right, than the investor. So I think your client is who your client is. So I would sell your client, right? That's what I would say. So they're taking advantage of this because they want to live here forever. This is a forever home, right? They're building in this neighborhood, that type of thing. I think you can sell it.
Just picture their children running.
When I walked up, I just pictured us swinging the tree. And,
To go back to the purchase agreement, let's say they have that like percentage down,
Mhm.
but then like, oh, but I'm interested in like looking at other options to do down payment assistance to more cash in their pocket. Do you have to go back then and do anything with that, or that's just like, we're gonna do this, now we're not gonna do it?
yeah, I've never had to amend anything on that end. Again, I think you're making that offer in good faith of what you think you know, but then, yeah, as long as they get, my experience has been the only flip on that is if you go conventional to FHA, because there are different rules with FHA that you have to have like the sellers sign an agreement for the FHA addendum. Obviously the appraisal is different. The appraiser has to be qualified to do an FHA appraisal, that type of thing. So if you're switching that way, you do have to let them know on that end. But with terms, I'm yet to see a thing where we have to say anything. Let's see, other things. Thoughts?
Percentage of closings are on an arm.
Actually, interesting enough, they're coming back in favor. The reason they weren't very popular for a while is because long-term interest rates and short-term interest rates, they were like equal, right? Nobody had an appetite for that, giving somebody an adjustable rate on that because they knew they're going to get out of it right away. But they're starting to spread out a little bit, and that's the advantage of having an adjustable rate. You give up you have to take on more risk, you get a lower rate. So I've seen more. I'm looking at them more often than I have been in the past. Most of my folks, especially a lot of people feel more comfortable with a 30-year fixed on that end, but especially jumbo because the spread's getting bigger, it's worth it to look at that. So I don't have statistics on it, unfortunately, but I do know just anecdotally that yes, it's becoming more popular. Of course, random banks will have some special that they'll throw out there. So those were always kind of floating around the last few years, but most lenders didn't have access to those funds. Those are usually relationship products that they're trying to get in. So I think we'll see more of that as long as the spread continues to stay. Next one. I don't know if y'all can see this, and I can email this to you. So Kelly from Profile pulled up the last 3 months of offers just to kind of see like what the statistics are on which offers are getting accepted and which aren't. I just thought it was interesting there. And I can email all of you on that if you'd like. Where did I find those? That's interesting. Oh, the other thing to think about, appraisal gap coverage when you're making an offer, right? A lot of things are going over multiples right now. So that's where you're having a conversation with the lender. What is their flexibility to do an appraisal gap, right? If they have 20% down, can they cover it if it comes short and we renegotiate the terms and go 10% and they're coming to cash? Does everybody know what an appraisal gap is, what it looks like mechanically on that? Okay, all right. Because it can be kind of confusing. So from a lender's, I'll say it anyway. From a lender's perspective, we go off the lesser of the appraised value or the purchase price. Okay, so if you have a purchase price of 500 and the appraisal comes in at 450, from a lender's perspective, they're only using 450. From a seller's perspective, unless they renegotiate that price, they still want 500. So your buyer would have to come in with the difference, right? And then we base our down payment off of that 450, right? So if you were doing 20% of 500, okay, maybe now we got to do 5% of 450, and they still coming out with cash. They might have to come with more cash. That's where the conversation of how much do you have available, right, for down payment, what you're comfortable with. You have that.
Way over the market.
I think it's going to happen again. It's happening right now. What I've talked to people, Rachel, you dealing with that? Yeah. It's happening right now, especially in the Twin Cities area. The further out you go, there's less competition out there. But there's going to be a lot of it, especially in the risk right now in the early spring. There is an appraisal risk because appraisers use most recent sales to justify the purchase price. So since we're early in the sector, you don't have a lot of those adjusted higher sales to justify their sales. So it's kind of it's not a science, it's an art. And that's where you got to have a good appraiser, honestly, to do that. Make it make sense that you have a higher offer. So that's another thing that'll come to, like, some smart listing agents aren't going to accept the highest offer because it's ridiculous. You're never going to get the appraised value on it. If it has financing, you're going to struggle with it.
So that multiples. Way over us.
Yeah. Oh, yeah. No, yeah, no room there, no chance. Yeah, exactly. Nice try, but
No explanation, like no call, no nothing.
I think that's the biggest thing that you guys can do when you're making an offer. Call that listing agent and talk them through it. Like, we're doing 3%. They have cash. They just don't want to put it into that, or they've got a rich uncle, whatever it might be. Like, we want this house, and there's some confidence that you can display out there. But I think a lot of people don't call the listing agent. I don't know why. They're afraid of them. I know listing agents sometimes don't answer. Leave them a voicemail. That's the biggest thing. I know it's weird. Listing agents, if y'all are listing agents in here, or when you become listing agents in here, I get it. Just at least listen to the voicemail, shoot them a text back. Save yourself some time on that end. But yeah.
Speaking of rich uncles,
I don't have one, sorry.
Yeah, me neither, I wish. And I showed up a few minutes late, so maybe you discussed this, but you had mentioned, like the appraisal gap being off by 50 grand. There's a limit on your gift money, correct? I thought it was like 16,000 a person or something like that.
So that's for taxes. And that is, so I'm not a tax expert, but A lot of people are afraid of giving more than that because they're afraid that they're gonna have to pay taxes on that money from the giftor, right? Is afraid of that. But my understanding is it goes against your lifetime availability of giving a gift. It was like 2.5 million. So you won't necessarily get hit with that. It's like as you're, giving away your fortune over years, there's a tax strategy to it, but not necessarily when you're giving for buying a home.
So like, let's say you're $30,000 off on the appraisal. And you got a family member that says, I can give you 30 grand to cover it, and then they settle it up between them after the fact, whatever, that's.
Yep, that's from, your lender doesn't want to know about it.
Yeah, no, I.
No, for the terms, basically, and that's why we get a gift letter. For the terms that they tell us, they're giving you a gift. Whatever you do after they close, I can't control, and I never try to on that end. But I've had somebody give a gift of $230,000 towards a house of, it was like a $350,000 house. So I ended up doing a loan for like $100,000. Whatever, it's cool. The guy was an ultimate frisbee champion guy, and like the weirdest, laziest dude I've ever talked to in my life. But anyway, thank God his dad had $250,000.
He was a disc golfer or ultimate guy?
Ultimate. Which you wouldn't think he would be lazy.
You gotta run your ass.
But he was lazy the rest of the time. I think he played hard. Well, you know the folks. He played hard there, and then the rest of the day was just very, very tired. 10 o'clock in the morning, cannot be bothered.
Mary Keller mentioned that too. It's on the family reunion slides, because it's gonna change actually the lifetime gift. So he recommends everyone find your rich relative and have them buy you a house now.
You have one, or have somebody marry into a rich family or something. Strategize. Let's see. Other questions? I don't think I have anything else after this. Other questions, thoughts that I can help with? Everybody get their bill of tacos?
That was super helpful. Thank you.
Yeah.
Good. Well, I'm glad to do it. Please don't hesitate if you guys have any questions, whatever.
Minnesota only.
So we lend in all 48 states. Yep, I'm personally licensed in Minnesota, Wisconsin, Texas, South Carolina, Colorado, Nebraska. I've had license in like 29 states on that. So, but in our office, we can do all 48. So,
What are the two that
New York, because they are an issue, and I think actually Massachusetts is the other one. Utah, but we have that. Yeah, I believe. We have somebody. Yes. It is hard. State by state, they all have their different rules. In New York, essentially what it is the condos and the co-ops that they have in New York City make it really difficult to get your license there. Well, I used to be tough because you had to have brick and mortar, which was great when I ran a team. Had a guy that we got to send to Hawaii to live, he and his fiance, for 6 months. And then we shut that whole business down, so he had to come back, but he loved it. And she was like, you gotta hire my fiance. She's way too tan. She's living the beach life. I was like, the sad thing is too, I was gonna have to go do a branch visit, and we shut down right as I was booking. So I never got to go. But other questions, thoughts? Awesome. Thanks, guys. Appreciate you coming out.
Thank you.